Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at SLV, specifically in the wake of, well, one of the most violent sell-offs in precious metals history that happened yesterday.
If you find our talks useful, please consider subscribe, like, and comment underneath. Okay, we need to take a breath here.
We do.
We are recording this on Saturday, January 31st, 2026. If you were watching the markets yesterday, you probably feel like you went 12 rounds in a boxing ring. I was looking at my screens, and honestly, for a second, I thought the data feed was broken.
It wasn't a glitch. It was a historic event. Friday, January 30th, is going to go down as one of those days that changes how people look at risk management.
It really was.
It was effectively a massacre in the metals complex.
Massacre is a strong word, but looking at the charts, it's really the only one that fits.
Right.
So let's unpack this properly.
Yeah.
For the listener who maybe tuned out for the weekend or was too afraid to open their brokerage app yesterday, what exactly happened at the scene of the crime?
The numbers are staggering. In a single trading session, silver crashed nearly 33%.
Just pause on that for a second. A third of the value vaporized.
In one day.
That is the kind of volatility you expect from, I don't know, a microcap crypto coin, not a global industrial commodity.
Exactly. We saw the spot price plunge from those historic peaks above $121 per ounce straight down to 76.
Wow.
We are talking about weeks of hard-fought gains, massive breakouts that had everyone excited wiped out in roughly 48 hours.
And it wasn't an isolated incident, was it? It wasn't just silver.
Not at all. Gold took a 10% hit, dropping below 4,700. Platinum and palladium just collapsed right alongside them.
It was a sector-wide liquidation. Everything that wasn't nailed down got sold.
Precisely. And for our focus today, SLV, the iShares Silver Trust, got dragged right into the abyss. The ETF plummeted about 15% recently, essentially mirroring that destruction in the spot price.
A sea of red.
There was nowhere to hide.
Okay, so here is where it gets really interesting, or maybe terrifying depending on your position. How does a major global commodity drop 33% in a single day?
Right.
I mean, unless we suddenly discovered a mountain made entirely of silver or physics stopped working, that doesn't feel like natural selling.
You're right, it wasn't natural. It was what I call a perfect storm. You had three very specific triggers that all hit the market at the exact same time.
How do you triggers?
If any one of them had happened in isolation, we might have seen, a 3 or 5% correction. But together, they caused a collapse.
All right, let's play detective. Let's break these triggers down so we can understand if this is a broken market or a broken asset.
Okay.
What was trigger number one?
Trigger one was macro politics and the Federal Reserve. President Trump announced his intention to nominate Kevin Warsh as the next Fed chair.
Kevin Warsh. Okay. Now, Warsh isn't exactly a new name in these circles, but clearly the market took that name and ran with it. Why did that specific nomination cause such a violent repricing?
Because the market perceives Warsh as a hawk.
And for those who don't speak central banker, that means he's the guy who takes away the punch bowl.
Exactly. He is viewed as less likely to print money and more likely to keep interest rates higher to combat inflation.
Okay.
In the world of commodities, specifically zero-yield assets like silver, that matters immensely. You have to remember, silver usually trades inversely to the dollar and real rates.
Right. If you can get a guaranteed high return in a treasury bond, why hold a metal bar that pays you nothing?
That's the logic. So the chain reaction is, Warsh implies higher rates. Higher rates mean a stronger dollar, and a stronger dollar punches silver in the gut.
And the market saw that coming
Instantly. When the news broke, the Bloomberg Dollar Spot Index rallied 0.4%. Treasury yields spiked. The 10-year was up 3 basis points. The 30-year up 5 basis points.
That doesn't sound like a lot to a layperson, 3 basis points.
Right.
But in the bond market, that's a sharp move.
It's a massive signal. It told the algorithms the easy money era might be pausing. So the dollar flexed and metals got bruised. That was the fundamental pressure. But then
we had the stranger part of the story. Trigger number two.
This is the part I was reading about in the notes, and it frankly makes me angry about modern market structure. This involves that Reuters report, correct?
Yes. This is where the intersection of news and technology turns against the investor. A Reuters exclusive report came out claiming that the U.S. government was ending support for strategic metals.
Which sounds catastrophic. If the government walks away, the strategic bid just disappears.
It sounds catastrophic to a human who reads the article and thinks about it. But more importantly, it sounds like a sell signal to a computer.
I see where this is going.
In modern markets, we have trading algorithms that scan headlines using natural language processing. They don't read the article for nuance, they scan for keywords and sentiment.
So they see U.S. government, ending support, metals, and they hit the eject button.
Faster than you can blink. We are talking about execution speeds in microseconds. When that headline hit, the algos read the negative signal and dumped positions instantly.
No human verification. Zero. There was no human trader sitting there verifying the source or calling a contact in Washington. The code just executed the sell order.
But wait, was the report actually true?
No, that's the twist. It was fake news, or at least incredibly inaccurate. The Energy Department later came out and explicitly called it misinformed or deliberately misleading.
Unbelievable.
The article was eventually rewritten and retracted.
So we lost billions in market capitalization based on a hallucination.
Essentially, yes. But here's the problem with algorithmic trading. By the time the correction came out, the damage was done. The stop losses had already been triggered. The capital had already fled.
It created a vacuum.
A liquidity hole that sucked everything down. It's a shoot first, ask questions later market.
Which leads us to trigger number 3. Because even with a hawkish Fed and a fake story, 33% is a lot. There had to be something fragile about the market structure itself to allow that kind of slide.
You nailed it. It was Friday, January 30th, the last trading day of the month.
Month-end flows.
Right. Liquidity is usually thinning out anyway as traders head for the weekend, but context is key here. Silver had just come off a parabolic rally.
It was up how much in January alone?
57%.
57. So everyone was sitting on massive profits.
Massive. And when you have massive profits and the market starts to shake, even a little bit, what is your first instinct?
You take the money and run. You protect the gains.
Exactly. So you combine rational profit-taking, thin month-end liquidity, a hawkish Fed announcement, and a fake news panic, and you get a cascade.
Forced liquidations.
Yeah.
Margin calls.
The definition of a market clearing out. It wasn't one thing. It was everything happening at once.
Man, talk about bad timing. It really was the perfect storm.
It was.
So now that the dust has settled, or is at least swirling around our ankles, let's pivot to the vehicle itself. A lot of people watching this drop might be thinking, okay, silver's on sale. But before they click buy, let's clarify what they're actually buying with SLV. This isn't a mining stock.
No, and that is a crucial distinction. If you buy a miner, you are taking on execution risk. Is the mine managed well? Is there a labor strike? Will the government nationalize the
Some of
asset?
that operational headache.
With SLV, you strip all that away. It is a grantor trust. It doesn't dig holes in the ground. Its sole purpose is to hold physical silver bullion.
So when you buy a share, you basically own a paper claim on a slice of a bar in a vault somewhere.
Essentially, yes. They hold over 510 million ounces of physical silver in vaults, mostly in London. The value proposition here is convenience.
Right.
If you want to own silver, you don't have to buy a safe, you don't have to pay for insurance, and you don't have to worry about storing heavy bars in your basement.
And you also don't have to deal with the futures market. I know a lot of retail investors get burned there with roll costs.
They do.
That's a concept that trips people up. Can you quickly explain why futures are dangerous for a long-term hold?
Sure. In the futures market, contracts have an expiration date. If you want to keep your position open, you have to sell the expiring contract and buy the next one out.
Which costs money.
It does. Usually the future contract is more expensive than the current one, a situation called contango. So you're selling low and buying high over and over again.
It's a slow leak in your tire.
It's like a slow leak in your tire. Eventually you're driving on the rim. And SLV eliminates that tire leak completely. It tracks the spot price directly. It has no debt, no traditional earnings or revenue because it's not a business, it's a vault. The expense ratio is 0.5%, which is the fee you pay for them to manage that storage and security.
So it's a very clean way to play the price action.
Very clean.
Now, looking at the crash yesterday, you mentioned something in our pre-show notes about liquidity being a moat. Why does volume matter for an ETF? Shouldn't the price just be the price?
In a calm market, sure, volume is less critical. In a crash, liquidity is the only thing that matters.
Explain that.
SLV has incredible volume, about 83.8 million shares traded daily.
That is massive.
It is. And here's why it matters. When the market is crashing, you need to be able to get out. Or, if you are aggressive, you need to be able to get in at the price you want.
Right, without huge spreads.
Exactly. Small funds with low volume can freeze up. You might see the bid price at $70 and the ask price at $75 because no one is trading. you get killed on the spread.
So SLV is the highway versus a dirt road. When there's a traffic jam, you want to be on the highway so you can actually move.
That's a great analogy. You pay for the liquidity, and in moments like Friday, it's worth its weight in, well, gold.
And it's important to zoom out, I think.
We have to. Despite the crash, we have to look at the context. Even with this drop, SLV delivered a 147.86% return for the year ending December 2025.
That puts the 33% drop in perspective. It's painful, absolutely, but if you zoomed out to the yearly chart, the trend still looks incredible.
It has been significantly outperforming gold. Over the last decade, SLV is up 298% versus gold's 286. So, while Friday was a bloodbath, the longer-term trend has been arguably the strongest in the commodities complex.
Okay, so that brings us to the thesis, the wealth-building question. Is the party over? Was Friday the sign that the bubble has burst, or is this the sale of the century? I want the bear case first.
Okay.
What is the nightmare scenario here?
We have to be realistic. The bearish case is real, and it revolves around volatility and contagion.
Contagion from where?
Crypto. We saw crypto liquidations hitting $1.68 billion recently. There is a surprisingly high correlation between crypto traders and precious metals traders, the anti-fiat crowd.
Oh, I see.
When crypto crashes, traders get margin calls. They don't sell what they want to sell. They sell what they can sell to raise cash.
Right. Cash is king when the broker calls. So silver gets dumped to pay for Bitcoin losses.
Exactly. So if crypto keeps sliding, silver could get dragged down with it, regardless of its own fundamentals.
Okay, that makes sense.
Also, historically, after massive rallies like the 144% run we saw in 2025, we often see a period of consolidation. We might not see vertical growth immediately.
So it could trade sideways for a while.
The market needs to digest the move. The average return after these types of spikes is historically around 5.9% for a while. So don't expect it to double again next week.
Right. Patience might be required.
Yes.
But reading through your analysis, you don't seem like a bear. You gave the bullish thesis an 8 out of 10 score?
I did.
That is incredibly confident given the massacre we just saw. What is driving that conviction?
It comes down to one word: industry. This isn't just about people hoarding coins because they're afraid of the Fed or inflation.
This is the real-world use case.
58% of global silver supply goes to industrial uses.
We're talking solar panels.
Solar panels, electric vehicles, 5G infrastructure, medical electronics. These aren't speculative trends. They are massive global structural shifts. Think about it. An electric vehicle uses significantly more silver than a gas car. Solar panels are pure silver paste consumption. And here is the kicker, the thing that the Reuters article and the Fed announcement didn't change.
What's that?
We are in a structural supply deficit.
Meaning we are literally using more silver than we are digging out of the ground.
For 4 years running, the world needs more silver for the green energy transition than the mines are producing. And silver mines don't just switch on overnight.
It takes years to get one running.
It takes roughly 10 years to bring a new mine from discovery to production. So you have inelastic supply meeting exploding demand.
Exactly. That fundamental fact didn't change because Kevin Warsh got nominated. The price changed, but the reality didn't.
The physical market is still incredibly tight. And that's why this crash is interesting. It creates a psychological flash crash entry.
An opportunity.
Also, there is a technical quirk here that smart money looks for. During a panic yesterday, SLV was trading 3 to 5% below its net asset value, or NAV.
Wait, explain that. How can the ETF be worth less than the silver it holds?
It happens in extreme selling events. Everyone is selling the ETF shares so fast that the market makers, the banks responsible for keeping the price in line, can't arbitrage it quickly enough.
It creates a discount.
It creates a discount. You were essentially buying silver for 95 cents on the dollar. It's a signal that the selling was panic-driven, not logic-driven.
Okay, let's get tactical. I'm looking at the chart. Where are the lines in the sand? If I'm a listener trying to time this, what numbers actually matter?
We have some very clear levels. The stabilization point on Friday, where the bleeding finally stopped, was the 50-day exponential moving average. That's sitting right around $70.81.
70.81. Why is that number significant? It seems arbitrary.
It coincides with the historical peaks from late 2025. In technical analysis, old resistance becomes new support. It was a ceiling before, and now it's acting as a floor.
I see.
If silver can hold that level through the weekend into Monday, I would expect a demand response.
Meaning the bargain hunters step in.
Exactly. Investors realizing the fundamental story hasn't broken.
And if it doesn't hold, if we wake up Monday and we slice through 70,
Then look out below. The ultimate floor is the 200-day EMA. That is sitting way down at $55.
55, that's a big drop from here.
It is. If we break 70 decisively, we could see a flush down to 55. That would be the back up the truck level for a lot of long-term bulls.
So, strategy-wise, how does one play this? Because catching a falling knife is dangerous.
It is. I see two distinct paths here. First, there is the swing trade. You are buying this dip specifically looking for that gap-up recovery.
You're betting on the market realizing the news was fake.
Yes. There is potential for a short squeeze here. If the market realizes the Reuters story was bogus and the Fed fears were overblown, we could see a snapback. The target there would be 20 to 50% upside heading into Q2 of 2026.
And the second path, the one for people with lower blood pressure.
The long-term hold. This is for the investor who ignores the daily noise. You aren't buying the dip, you are buying the industrial supply crunch.
You're buying the deficit.
You are betting that in 5 years the world will have more solar panels and more EVs, and they will need silver that simply doesn't exist at current production levels. It's the difference between trading the news and investing in the trend.
And SLV works for both, you're saying?
It works for both, provided you understand the volatility. You have to be able to stomach a 33% drop without panic selling. If you can't handle Friday, you shouldn't be in silver.
You know, it's funny. When you look at it this way, the crash feels less like a disaster and more like a reset mechanism.
That's often what these events are. It shakes out the weak hands, the tourists who bought just because the price was going up. It transfers the asset to the strong hands, the people who understand the value.
So let's wrap this up for the listener. Give me the final verdict, the elevator pitch.
The elevator pitch is this. SLV offers direct exposure to a commodity that doubled in 2025 due to real, tangible industrial need. The crash we saw yesterday, that 33% drop, was driven by a toxic mix of politics, a fake news algorithm error, and thin liquidity.
It wasn't a change in the fact that we need silver for the green economy.
No. The fundamental demand hasn't budged. Volatility is going to persist as the market digests the Fed news, absolutely. It's going to be a bumpy ride next week.
Yay.
But for those with the stomach for it, this abyss might actually be a launch pad.
A launch pad. I like that. It's a reminder that sometimes the best opportunities look the scariest in the moment.
They almost always do. If it feels comfortable, you're probably too late.
That is great advice to close on. If it feels comfortable, you're too late. All right, that's where we are going to leave it for today.
Okay.
We want to know what you think. Is silver going to hold that $70 line on Monday? Or are we flushing down to 55? Drop a comment and let us know your price target.
And don't forget to check your own risk tolerance before you jump in. This is high-octane stuff.
Absolutely. Thanks for joining Smart Wealth with Joshua. We'll see you in the next one.